to break multifactorial things that are very complex and have a lot of variables into one single answer. Because it's easier that way. We can understand it.
This chart reminds me of something else. We've all heard in our career that you need to get out of the stock market the moment the yield curve inverts.
Yep.
CNBC ran with this heavy a year and a half ago.
Yeah.
Hasn't worked out. No.
This is another
forward-looking
expectations.
expectations.
Anytime you see something, well, every time this happens in this election year, the inverted yield, get out of the market, get out of the market.
It has to be a recession, right?
This is another evidence, because anytime you try to time the market, getting out is easy. You hit a button, you're out. The hardest part is getting back in. So anyone that got out of the market because the yield curve inverted because CNBC told them to, or 63% of the time it's worked or whatever, you would have had to. You're either still in cash, kicking yourself, or you're going to be forced with a decision on when to get back in. And I didn't know it was 19 months, but that's crazy that we've been inverted for 19 months. So anyone who got out of the market because the yield curve inverted, which there was a case for that, it's been a year and a half where they were just waiting for that correction. And by the time the market actually corrects, and I'm sure it will at some point, it'll probably just go back down to a fraction of what it peaked at, but still well above where they got out.
Yeah. Well, and they'll talk about that far right part, right? So they've been out, but they've got that 5% in their money market cash or short-term rates that they've been able to do, and so they're still viewing it as positive. But again, then it comes back down to reentry, right? So markets are 21% higher roughly. So at what point do you get back in from where you got out? And so
the biggest, this is a mouthful, but I've said this a bunch of times whenever I talk about the market is a multifactorial, organism, for lack of a better word. And there are so many factors that influence the market, and so many that I don't understand on a daily basis, or at least understand why it's moving a certain way. And sure that experts don't understand, and surely the average investor doesn't understand. So when you see one signal, and this is kind of the way we've gone, again, I'm getting a little philosophical, but kind of the way we've gone as a society. We want to break multifactorial things that are very complex and have a lot of variables into one single answer. Because it's easier that way. We can understand it. Inverted yield curve? Always get out of the market. Always. Well, not always, apparently, because it didn't work. So all of this stuff, again, with the market and the whole, that's why we go through these things, the elections, all these different factors. They're just a single factor that could possibly influence the market, and there's so many other factors. Like I said, the one thing we understand is that, prices and prices will probably move forward, move up. The world will probably keep going. Things will probably be more expensive in 10 years than they are today, and that's the purpose of investing.